Okay, you're watching Starting Bell. I'm Betty Lou. We are about 20 minutes away from a new trading day. Stock futures are pointing to, well, stock futures are a little changed right now, but you are seeing the S&P 500 futures index pointing to a little bit of a lower opening. Well, my next guest says that, in fact, the S&P is poised to gain by about 8 to 10% this year. He is David Edwards, president of Heron Capital, and he joins me now in the studios here. Hi, good morning, David.
Good morning. How are you?
Okay, before we get to your forecast for the markets, I do want to ask you, Citigroup earnings came out slightly better than expected, but you say a lot of these companies have already been lowballing their estimates and coming in with better than expected results. So is this really a true surprise?
No, it's not at all. I think a lot of these companies were very aggressive in the spring. They were blindsided by the results. Luckily, they have the financial control systems to be able to quickly evaluate their situations, get information out to the markets early, lowball early, so that when we actually get to the actual report, nothing to get upset about.
Would you say this is an all-across-the-board problem, or is it more in specific industries?
Well, financial service stocks for sure stretched for return this past year and fell on their faces. But ever since Sarbanes-Oxley, all companies have been very aggressive about pushing down their numbers and letting the street be surprised at the upside.
Okay, well, what do you think about these Citigroup results? I mean, they came in better than expected, but obviously they're still writing off a lot of bad loans, still got a lot of problems with liquidity. I mean, what would you say this is in terms of a benchmark for the rest of the bank earnings coming up this week?
Well, psychologically, they said, well, our earnings are going to be down 60%. And so they surprised to the upside by coming in only down 57%. Down 57%, that's really horrible.
Right.
But these are all smart companies, and they'll lick their wounds and go back to the cave and come up with new products and strategies. And Citigroup is a company we've owned for a long time, and we continue to hold it through this fiasco.
And what about in terms of their consumer banking unit? I mean, how encouraged are you that they're actually fixing that up? And
it seems like that's where the revenues are for a lot of banks. We walk around New York City, every block has a new bank branch on it. Someone's paying for that. I focus on Citigroup more for international operations. It's a world brand, branches in 107 countries. That's what I'm interested in.
Okay. What about in terms of the other banks? I mean, are we going to see a lot more write-offs coming up? Are we going to see some more surprises, do you think, or on the ugly side, really, for the other banks that are coming up? We've got Bank of America, JP Morgan.
Right. I think not. I think all banks will show numbers, and I also include the investment brokers, Bear Stearns and Morgan Stanley in that category. Goldman Sachs will also show numbers dramatically worse than last year. I don't think you're going to see a lot of big bonuses in New York City this year as a result, but they will move past this as they always do. And
will this be the worst quarter for the banks, or do you think we'll have worse
I think
to
so.
come? Okay. Okay, David, well, let's talk also about, the overall earnings picture. I mean, we're going to get, Intel this week, we're going to get Google, Yahoo, all of these guys. Are you going to see pretty healthy profits considering what we're seeing right now in the housing?
We've had 21 straight quarters of earnings growth above 10%. The forecast right now looks to be about 9% across the whole stock market. That is a phenomenal streak of earnings. And when you balance that streak on the one hand versus the people looking at the flat yield curve and saying, oh, this presages recession, you say, well, there's two data points that say the opposite. Where's the truth? And the truth is the U.S. economy, because of the housing market situation, is going to be depressed in its GDP growth by about 1% a year for the next 3 years. But meanwhile, I look at the S&P 500, I see 40% of its revenues coming from overseas operations. The rest of the world looks terrific right now. And you combine that with the falling dollar, all that overseas operations discounted at a premium price, all flowing into the earnings. It looks great. I wouldn't be surprised if we went 22 quarters with plus 10% earnings.
And you're saying that the streak will continue, you think?
At least for the next 6 months. I am looking very carefully at how this mortgage fiasco plays out. This is something that we talked about with our clients for about 3 years, saying, look, be careful about real estate, It looks dicey to us, looks nice to us. We thought maybe there was a bottom forming this spring, but it just got worse.
Right.
So now we have to wait another 6 months and get some more news out and make some forecasts after that.
Okay. Very quickly, David, I mean, at what point do you think the higher price of oil, higher price of commodities is really going to hit the bottom line for these companies? Because so far they've been buffered by it.
Right. The price of oil is baffling to us. We had a forecast out at the beginning of the year, $55 range for oil. We gave up on that in August when it was at 69. Now it's at 85.
Right.
We look at retail statistics and we see that the average American consumer gives up eating out and buying clothes before they give up on gasoline. we hadn't expected that, but that's how it is.
Okay, thank you very much, David. We're going to be right back with you. We're going to be back with David Edwards and get his 2 top stock picks. Plus, oil is hitting a record. Sue Keenan of the NYMEX will give us the lowdown on what's greasing the wheels there. Well, we are a little more now than 12 minutes before the market opens. Futures have just closed, and they do indicate, well, a little changed opening. S&P futures are off by about 0.7 of a percentage point. We are back with David Edwards of Heron Capital, talking about some of your top stock picks. But before we do that, you know, after the recent correction we've seen this summer, is now a good time to go bargain hunting, you think, for various companies?
I put myself in the camp of cautious bull. One of the models that my firm relies on is the Fed model, which is basically a way of discounting forward S&P earnings by the current 10-year Treasury. And this time a year ago, that model showed about a 19% discount, fair market to actual market. And now that discount is only 11%. So there are things to buy. There's always stocks to buy, but you can't just go in blindly. Be a little thoughtful.
Right. Got to have a little bit of a strategy in there.
Little strategy, exactly.
Okay, so David, one of your stock picks, AMBAC, which is I think it's one of the world's largest bond insurers, if I'm not mistaken. Why go into that right now? Obviously, the bond market getting hit.
Sure. One of the classic investment strategies is to look at property insurance companies after a hurricane goes by. Katrina, for example. People just dump the stock. They're afraid of those claims. And then 6 months later, you go by and you discover that the insurance companies don't actually insure the houses that are on the floodplains, number one. Number two, they tend to have a lot of reserves. And so we've got 2 companies I'm interested in right now, AMBAC and also MTG, that are in the business of insuring financial securities. AMBAC insures bonds, particularly the CDOs that were all in the news this past year, AAA-rated company, and MTG insures home mortgages. And both of those stocks are down 50% from their highs earlier this year. They have compelling valuations, a PE of 7 or 8, a PEG ratio below 1, terrific return on equity, but yet everyone hates them. So that's when we step forward and say, you know what, is this a temporary impairment of their situation or permanent? And we think actually they're going to have terrific numbers next year. And we've had these stocks for a long time. We're adding to our positions right now in both of them.
Right, so a bit of a contrarian point of view. Now for AMBAC, though, I think recently they announced a quarterly loss of about $743 million. I mean, is the worst over, though, do you think, for this company?
I think, yes. One of the most intriguing things about a situation like this is that in the last year or two, investors or mortgage seekers actually were shying away from paying those insurance premiums to AMBAC or to MTG because they didn't have to. And now they're finding that if they had these companies coming in earlier and kicking the tires a little bit and saying, you know, this is not as good as you think it is, or your model that's relying on guessed prices as opposed to hard numbers is way off.
Right.
So just as with property insurance companies, the premiums go up after a hurricane, I think you'll see these companies also having a big kick up in premiums as well.
So basically jumping in when others are jumping out. Thank you very much, David. That was David Edwards, president at Heron Capital.